Welcome back into another podcast. Today is going to be a good one because we are going to dive into whether or not this is the time to invest. Is a year-end rally in store? We'll talk about the Fed. We're going to get into all sorts of things that could give us an insight into 2026 around the hottest crypto and investment projects out there. You don't want to miss it. Let's just jump right in. I do want to thank our sponsor today, and of course, that is Uphold. And many of you guys know Uphold has been a big partner for the channel. We appreciate everything they've done. And if you've not visited their website, go over to uphold.com. You guys can, of course, get staking rewards now on up to 20 different tokens. You also have the potential of getting in on over 300 different assets that are available. Probably the most favorite thing I like about Uphold is they give you almost like an insider's pitch on early tokens. So you get access to new things happening very fast, whether you're an individual or a business. You can, of course, join over there. Last but not least is this right here. It is the card with the most XRP rewards that you can get, up to 6% on everything you buy for about 3 months. And it's not a credit card, so you don't have to go through all that. It's a debit card that works into your digital asset account. So check out Uphold. Use our links down below. You guys are going to love it. Let's get into some of the things today I wanted to hit on. One, of course, has been this whole AI prediction model. Now, you guys probably know that we cover AI predictions quite a bit, mainly because we have a full AI LLM that we use for some of our own tools and some of our own analysis. One of the things that has been hitting right here is this new analysis of AI predicting an XRP price rising in Q1 of 2026. I don't know if this is going to be a thing, but it's very possible that they are developing some fairly good language models that may get into the point where we can start to maybe depend on them a little bit more. Let me know in the comments if you think we're going to see accurate AI models in 2026 going in. Another thing that, of course, has hit, and that is the fact that we're starting to see a little bit of outflow coming into both Bitcoin and Ethereum ETFs. I shouldn't say a little bit. This is heavy outflows. And then Solana and XRP have been staying green. So all of institutional capital, when you think about this, is that most of it has been pushed down into Bitcoin and ETH over the last little bit. However, with the recent launch of all these XRP ETFs and the Solana ETFs, we have started to see traditional capital, institutional capital, and Wall Street starting to move in on a lot of those. So beyond the hunt, I think we are going to see a very active ETF season going into 2026, along with some other very interesting things. We've got some good stories to cover as well. We're going to hit on this one today, which is, are investors piling into stocks as cash levels now are starting to sink to a record low? So we wanted to bring in an expert on this today. And of course, that is Miss Rebecca Walser. Let's just bring her into the show. Hey, Rebecca, how are you?
I'm great, Paul. Thank you for having me back. I really enjoy being with you.
Let's get into what's happening here. The story is pretty self-explanatory. Fund managers calling this the most optimistic scenario since 2021, despite a lot of people worried about tech valuations, AI models right now. What would you say? Are you bullish, bearish? Where are you right now?
Ooh. I'll give you a mixed answer. We are bullish on the new frontier. I mean, we're bullish on all these AI, quantum, robotics, blockchain. We're bullish on all of that. But overall, in the global economy, I would say we're more bearish. And that's because we're getting to the aging, and we've talked about it before, we're getting to the aging of the fiat debt-based system. Yep. There is a need to transfer to something else. And that need is going to predicate multiple actions being taken by central banks, as they have been since 2020, especially since the pandemic. And so we are macroeconomically bearish globally. But on the frontier of what can happen with the new technology, you have to be a participant, and we're bullish on that.
Okay. With that being said, U.S. equities now trading near record highs. We continue to see the AI trade play out. And even though we've seen a little bit of a dip in both NVIDIA, Oracle, we've seen this with, what we've seen around Coinbase and Robinhood also starting to take a little bit of adjustments on the finance side. But yet banks, when I say bank stocks, many people still think they're undervalued. I was listening to Tom Lee the other day. Is there any sector that you think is maybe the one to watch right now, especially into Q1 of next year?
I mean, I think I'm not exactly sure what Tom's point was, but I would imagine that what he's saying is based on the fundamentals of banks, they could be undervalued. But when we look at the fact that I believe that traditional finance is dying, and that unless you're like a Visa and you're literally trying to morph yourself into a blockchain company that can tokenize and accept stable coins, then I think that the banks have a very short window of utility. And I mean less than 60 months. Like we're looking at the end of the banking sector as we know it. And it's going to happen very fast. The second you start to see, and this will happen in 2026, Paul, the second we start to see monetization of payment streams on the blockchain as a normal course, which is going to begin to happen, then you know that the time clock has started for the traditional financing sector and the traditional banks. And so from that perspective, I would say that they are probably overvalued just because we're looking at the end of banking as we know it. It is
interesting.
Yes.
I like your analysis because I would agree with you is that, we put up a poll today on X, and sometimes it's, you're kind of going into a microcosm, at least on my account. But the question was, of these four companies, which one wins crypto in 5 years? And Jamie Dimon, of course, JP Morgan Chase were in there. But we also put other traditionals. Fidelity was in the list. We put in Coinbase and Robinhood. Coinbase ended up winning the poll as of this morning by about 1,000 votes. I was intrigued with that because that to me says one thing. And of course, most of my followers are very into decentralized finance, more so.
Absolutely.
But we are starting on this channel and our main channel, we are starting to pick up a lot more traditional finance investors.
Yes.
That are looking at this category for the first time. So to your point, maybe this is the beginning of the end.
Yeah.
For these big boys.
Absolutely.
Can you imagine a world without the big banks?
Well, I can. Absolutely. And I think that part of you're seeing these traditional finance investors come over is because of, the democratization of blockchain through ETFs. And so now they're like, what's going on? So you might be a little bit of an echo chamber with your group, but I love that it's a broad group and a broad poll. But for sure, you're going to start getting traditional people that are like saying something's amiss, something's changing, what's going on. And JP Morgan, interestingly enough, just named Visa as their payment processor of choice because of their ability to implement stable coins, tokenization, blockchain technology. So I am with them on, hey, if traditional finance is going to survive, Paul, it's got to get to the blockchain. It has to.
Well, and I think they finally see the writing on the wall. We're not dealing with now a scenario where we had to fight them anymore. We're at that phase of the cycle where they join you.
Yep.
And now it's kind of a race to the top. I guess that's the real question. You think that traditional finance will not be able to outcompete this next generation of fintech companies?
Well, I mean, it's subpar at best. The SWIFT system, basically from, I would say, the last major improvement in the 70s, it's the equivalent of fax technology today. You can't, it's very easy other than it's entrenched, beyond entrenchment. Once you pass the point of entrenchment and you get people to start looking at an alternative, it's going to be very difficult for them because there's just nothing that the Swiss system, the fiat system is really offering people that is not performing better on the blockchain. So,
well, I mean, they're not winning, which is why they're not winning the yield wars, which is being done mostly through stable coins right now instead of money markets. That's one. If they are successful in forcing the Clarity Act to kind of massage around the system, that would be the only thing that I'd be a little bit concerned about. Yeah. You don't think that's going to happen? Doesn't matter.
I just don't think that this administration, although obviously we're talking about Congress, but this administration is very clearly pro-blockchain. And we got rid of Gensler. We got rid of the people that were sort of in the, entrenched positions that would probably try to stop it. And so I just cannot see that Congress is going to pass something that's going to set us back, multiple years on the development of the blockchain. In fact, it would be really detrimental to the United States of America because it would just keep going. It would just go somewhere else.
Yeah, for sure. Well, I think the scenario that this plays out right now is, are we becoming the global leader in this category? And are we too narrow in focus? And I'll talk a little bit about that on the AI play before we let you go. But when you look at blockchain and AI, we have a czar up there with David Sachs under the Trump administration. So he's clearly focused on these two major categories. Do you think that the U.S. is a little too narrow, where China is going over here building into gold reserves, trying to look at energy, changing their model around sustainability and long-term, growth and what that might look like. Do you think we're too narrow right now?
I mean, I think that we are behind the eight ball, and we are absolutely too narrow. This is just, I don't want to be hyperbolic, but this is the end of all things as we know them to be, and a new way of doing all things. And it's not just blockchain technology, but we're talking about AI, we're talking about quantum, we're talking about robotics. And cloud computing was sort of the very beginning stages of let's move this outside of physical, tangible, holdable material, a physical server in your office. Let's get it on digitized and outside on the cloud. And then let's move it to, let's get quantum computing, AI algorithms. Let's develop applications. So this administration is the right administration for this change because they're obviously much more pro blockchain than obviously Biden and his people were. And before him, anyone else, I think Obama would have just been the same. So we have the right administration, but that doesn't mean that all of the people are being proactive and preemptive. And if we we rely too much on the fact that the US dollar is still the world reserve currency. But if you look at, foreign exchange and our reserves in that, it's dropping and dropping. And so what we need to do is make sure that we're being proactive and preemptive to cut China off from being a dominant player or at least dominating the United States. We cannot rely on our just natural status as the world's reserve currency because the blockchain will eventually do away with the need to even have fiat domestic currencies.
I definitely like your attitude on this. Always take no prisoners. Take that prisoners.
Exactly.
Speaking of taking no prisoners, we got to talk about what's happening with cash positions right now. Cash holdings in portfolios dropped 3.3% in December. Though that is down from 3.7% in November, it seems as we're getting a little bit of liquidity coming into the market. Is this the beginning of something, or did we see a little bit of faux QE come from the Fed this last week? What do you think, Rebecca?
Yeah, I absolutely think that the Fed has made a pivot, whether they want to publicize it or not. But using open market operations, they are stimulating. Again, you might not want to call it officially quantitative easing, but we are definitely ending. The QT ended, quantitative tightening ended, and we are moving back to accommodation. And that's beyond just the rate cuts. That's the actual liquidity of the system. And it's necessary, right? Whenever we start to get a more restrictive economy, layoffs increasing, job growth hampered, unemployment ticking up this morning, 4.6%. We expected 4.5%. We start to see liquidity drying up. We are a 70% consumer spending-based economy. So the second that liquidity begins to dry up, the Fed, if they don't react aggressively or preemptively, like I've been talking about, they're going to be reactive and it's going to be a problem. So they are getting ahead of it on that, on the open market operations side, to make sure that the liquidity is in the system as it is necessary right now, because we do have some issues.
Yeah. Well, speaking of the issue around liquidity, because this is going to be something that plays out into the Fed chair's position, we'll talk about who that could potentially be. But before we talk about who, let's talk about the timeline. And what I mean by timeline is, sure, another 40 billion goes into the balance sheet. Many people say, hey, that's maintenance. Don't worry about it. I love how 40 billion is maintenance. Double what you need for your balance sheet. What would be the QE switch? Or do you think they're going to try to stealth this into the system?
I think they absolutely are going to stealth it into the system. It was a really fundamental change, Paul, with Janet Yellen, really, between her two positions as, in the Treasury and the Fed. And that's because she really changed the way the Fed funds the government by making everything on the short end of the curve. And then, of course, as rates rose aggressively as fast as we saw them, you couldn't really finance our needs on the longer end of the curve. So now we're really hamstrung, right, by the fact that everything has to be short-term financing, and it gets redone every less than 2 years. And that makes the interest rate and the interest problem all that more under the microscope. So the Federal Reserve is going to have to do unique and creative things we've never seen them do before. Just buying another 30, buying more treasuries. This is something that is going to continue until we actually solve our interest problem, which is only like thinking of a snowball running downhill. That's where we are now. The snowball is starting to build up, and people don't understand it's our second largest expense now, only surpassed by the big Social Security. Basically, that's it.
So what you're talking about is hyperinflation. I mean,
Absolutely.
you're talking about there's no way to stop this train on the inflation side, but you can't let the jobs get out of control, which is what's happening right now.
Yeah.
Continuing to soften on the job market. It's very possible it could be getting worse as we go into 2026. So the Fed has no choice, right?
That's exactly right. And the only hope for all of us in our country, because as we lose the reserve status that we've had since Bretton Woods, as we lose that, as that becomes less and less important, as more alternative payment streams on the blockchain come to fruition, we have to rely on our GDP growth through AI and through the new frontier being so much better they can overcome the increase in interest expense that is exponential at this point.
All right. I have a question for you, and that is this right here. Let me bring up this screen. And this, of course, is Jamie Dimon, which I would say is kind of an arch enemy right now of the administration. But Jamie Dimon asking for more support around Kevin Warsh. So this is getting away from what has been kind of the leader out there in Hassett. Who gets the chair position in come May? What do you think?
So I am going to probably maybe surprise you a little bit and say, I don't think either of these gentlemen. I actually am betting on Scott Bessent. I think that
Bessent to take the chair.
I think that Trump is
so he's going to run the Treasury.
Well, I mean, that would remain to be seen, right, if he would stay as the Secretary of Treasury. But I do think it's a 10-year appointment, and he is the best economic friend this president has publicly, and he is so well-spoken, he is so articulate, he is able to explain very complex economic concepts to the lay person. He makes his case extremely well. He is probably President Trump's best economic advocate. And so I think for that reason that he's gonna ask him. That's my
So all right. So that's a big one, I think, in the sense of, because this has been talked about before. We've kind of in the early days, Bessent was being kind of thought of, and he denied it at the time. He was like, no, I think, I'm a better Secretary of Treasury, and this is where I need to be. Maybe he's done the deals enough that he can kind of step away from that, because he's also acting, commissioner of the IRS, I guess.
Of course.
So, I mean, he's got a busy day apparently up there in DC, but this would put some pressure on the traditional banks.
Yeah.
And because of the way Bessent has kind of forecasted his vision of where the next generation of finance is coming from, what would be his first moves as the new Fed chair?
Well, I mean, everyone thinks that Trump is going to get his man in there, and then all of a sudden interest rate policy is just going to be an easy breeze. We don't actually see that right now. We really see the Fed as probably the most divided it's been in recent modern times that I can remember. I don't think I've ever seen a 6-week period in the modern times, and I'm talking about the last 15 years, where in the middle of the 6-week period we went from a 90% probability of a cut to a 20% probability of a cut back to a 90% probability of a cut. So the volatility of the prediction market on what the Fed is going to do shows that there is massive problems. There's definitely disconnects in there, and there's a lot of I'm sure you've heard the term over the last week, Paul, silent dissenters. And those are the people that are not even saying that they would not vote for a cut, but then when the minutes come out, they put their notes in and say, yeah, I would not have voted for an actual cut. It wasn't as divided as it was in October. This meeting was a little less divided, but if you look at the actual Fed presidents, they seem to be very leery of us cutting into this growth that we've had on the stock market. They feel like, it's maybe to reserve dry powder, although, our job data was mixed for November and October, but our employment did tick up again unexpectedly. And I think that is going to continue to put pressure. But again, it is not all in for cuts. And I don't care if it's Bessent or whoever, they're going to have their hands full and really getting consensus, because it's a very divided Fed right now. Beyond just
to your point right there, U.S. unemployment, this is the other mandate by the Fed, is trying to control what's happening in the job market. U.S. unemployment rate hits 4-year high. This is even more so than what we saw during COVID. So 4.6%. You can see the climb right here from really the end of 23. And then this, what many people would say is a skyrocketing ascent right here for U.S. jobless rates rising. This has been the thing that I have argued for the last 18 months, and that is that the issue with the job market is much more dire than I think a lot of companies and people realize.
Yeah.
What does this look like in 2026? Is this going to continue up for a while?
Well, it's hard, right? Because I mean, obviously, if you can get accommodative, short, lower rates, then that helps, right? It certainly helps small caps. We know that. But the truth is that once you saw rates regressively, hiked up from 2022 to 2023, and then to stay that way until we started on this cutting thing that we've been on now, it's very difficult to have that kind of inflationary pressure and continue to expand your workforce, because you're now in the position of having to give your existing workforce some kind of cost of living increase to deal with prices. Otherwise, they're going to feel like they're losing money, and that's the issue. But we don't see massive wage growth. We don't see wage growth keeping up with inflation. So you have that pressure already on employers. But then, you have the beginning of the monetization of AI. And I don't want to scare people, but let's be honest, the reason that we think that there's going to be massive productivity gains and GDP and all of these things is because we do expect that AI is way more efficient than human capital is. And so we will see attrition. We are already seeing attrition of not the higher numbers coming down. Layoffs, yes, being announced. We know Verizon had their largest layoff announcement ever in their history. This, just this last couple months. So we do see that the layoffs are going to be increasing. But what I am more concerned about is the ability of employers to keep up with wage growth. It's not happening. And
it's the more with less.
Yeah. And so now what they're actually doing is, I don't know if you've noticed, but in the quarterly, projections, there's a lot of CEOs that are talking positively about layoffs as cost containment. And, it is on the one sense cost containment, and it is better for productivity. But as far as the overall economy goes, losing jobs and having our employment rate tick up is a whole nother problem that the Fed is then squarely looking at, as opposed to just inflation.
We just did another wealth seminar in South Florida. It was up in Palm Beach, and you had to be a C-level executive to come in. And that validates what they were saying, is that very thing, is that a lot of C-level executives are looking at this right now as an opportunity to improve their cash position and their balance sheets where they weren't necessarily profitable because of their high cost of labor.
Yeah.
So basically what they're doing is just not hiring new, as either jobs get replaced or people retire, or, rotation of people leaving the space, going to do something else. They just don't put that job back in if it has any capability of being filled by AI.
Yep.
So that's a big deal, because this is going to slow growth down. So you've got job growth slowing, productivity increasing, and then you have all of the factors happening around inflation, which does not appear to be slowing. I mean, could we get into a really reckless inflationary period here in the United States?
Well, I mean, certainly with the amount of expansion of our capital, of our monetary base since 2020, I mean, between fiscal and monetary stimulus, we're talking the equivalent of approximately, anywhere, some numbers say 8.3 trillion. I'm going to say closer to $10 trillion. And you cannot absorb, and that's not just us. The rest of the world also printed the equivalent combined of another 10 trillion US dollars. So you're talking about the increase of $20 trillion since 2020 globally of currency. And that is not possible to absorb that's why we had over a 9% inflation rate under the Biden administration. That is why the Federal Reserve had to raise rates as aggressively as they did. I don't know if they had to do it that fast, but they said, oh, wow, it's not transitory. Let's switch gears. Let's raise. And, you've got the Bank of Japan now facing the same exact situation where they're having to raise again from 0.5% to 75 bips, this tomorrow and Thursday. So this is, the whole world is facing the ramifications for just oversupplying the world with currency to get through the coronavirus pandemic.
All right. So this gets into, Rebecca, how do we fight against this? Because we're talking about jobs slowing down at the very minimum. Real wages not necessarily increasing at an optimal pace that keeps up with what's going on with the inflationary side of things. And then you have to ask, okay, well, where are people going to go? What are they going to do? Are we going to see more and more investment into assets, and that's the only way out? What's your thought on this?
Yeah, it's just the existential question that I don't believe anybody that is all of these smart people that are working on the blockchain and AI and all of these things. No one's actually dealt with the economic question of, the loss of utility of human capital and where do you go from there? So I think that, your investors, your group, they're very well positioned because they probably see that this is coming and hopefully they're investing in these technologies on the forefront, the early stages and have made some gains. But this is the existential question, Paul, that we have not had neither a pioneer of any hyperscalers, Mag 7, Jamie Dimon. No one is really a thought leader in this area to talk about what is the transition. And I don't know if it's because they're afraid to admit publicly and openly that AI will eventually, I can't tell you how many papers are now being written about the fact that AI will create and add jobs, which is just, ridiculous on its face. Everyone can understand that if you start to use computers and machines and computer learning and, general
better productivity.
Everyone understands this is going to be a loss of human capital and the inability as a human being to actually, with merit, with meaning, contribute to your gross domestic product. And so if you're not contributing to your GDP anymore in a valuable way that actually can be quantified with a number, and i.e. a salary that you then get to take home and have disposable and decide how you're going to do it, then what are we going to do? And so what we really need is a thought leader to step forward, or we need some kind of task force. I would love this Trump administration to set up task force.
They're going to need one.
We need a lot of work. We almost need like a Manhattan Project about human capital and the age of AI and how to continue to offer some kind of valuable contribution to GDP so that you're still compensated. Because in the event that you're not, and UBS is not the solution, Paul, because UBS means that the government or somebody else who decides to set universal basic income, basically gets to decide what your utility and your value is worth. So that's not us controlling our own destiny. That's not the solution. A UBI is not the solution. And in fact, in UBI, in the economic circles, a lot of times, UBI is the equivalent of nothing. Because if we're all given something, then it's the equivalent of us all given
productivity
really nothing.
Falls to the floor. Yeah. You end up with kind of the techno elite that figure out how to utilize things and probably end up, repositioning the entire economies and ecosystems outside of the area where you end up with this. And it's like real world Hunger Games is what
and actually that's the prognostication, isn't it? That there will be an elitist super group of humans that will run all of the machines, and the rest of us will be on UBI and just who knows what we're doing. But we have no input, we have no say. We're just sort of watching movies all day, and then there's a super select group of humans that run the actual world with the machines. So,
man, sometimes Hollywood gets it right. There's many movies about this stuff. Exactly. While we've been talking, we've got this up on screen. Cathie Wood buys 59 mil in battered crypto stocks. This is as the market crashed. She has been a long stalwart of tech on the ARK Invest, exposure. Overall, crypto related has been in her bag, but we see more and more, even with her adding Bitmine, which is Tom Lee's, Ethereum digital asset treasury. And the likelihood is I anticipate she's probably going to start to double down, because right now Bitmine, which I was blown away with, even though it was down, it's still a large percentage of her portfolio. Do you think we're going to see this kind of strategy from more people like you, which are starting to look at this as either a trending down bear market or possibly kind of a choppy sideways market before we see a bull run? Where do you stand right now on the current bull versus bear?
I'm definitely, it's hard. What I'd love to see, Paul, is some spreading out, if you will, from just the hyperscalers. I really want to see that we're not just getting, I think your 2025 can probably summarizes, it was a great year for AI and a lot of, returns and profits made, but it was really sort of, segmented to just hyperscalers to hyperscaler deals. Like I think Oracle coming in using debt financing and rightfully so, they were punished last week. Their stock price was definitely punished after their earnings, because we saw how much they're spending on their data centers and they're using debt financing to do it. And their debt ratios are just outrageous. And so they've got punished by the market, rightfully so, I believe, because before that, the hyperscalers were just using free cash flow, standing cash, which is what we want to see. We want to see that you have the money to actually make the investment. You're not having to borrow to make the investment. But from the perspective, I noticed you had invested in CoreWeave, and we understand what's happened with CoreWeave, even just these last couple of weeks. So, maybe she's buying on the dip. I don't know, but she obviously believes in the blockchain, and she'll also state that the use case of having the blockchain perform during a market crash, either a declared recession or an actual something even larger than
that. Will be the question. If we see performance there, then you're going to see a pretty significant adoption, I think, from Main Street, Wall Street.
That's right.
In the sense of institutional capital, for sure, coming in, because they're going to figure it out as this is the early AI play.
Right.
If you could get in NVIDIA when they were still being, they were still a gaming chip manufacturer.
Right.
And understood really where they were going as a whole. If you were following Jensen and listening, you probably knew.
Yeah, we couldn't get an interview back then when it was a gaming chip.
Yeah, no kidding.
It was amazing, right? Amazing.
Okay, so with all of that, many people would say, all right, well, this starts to unwind a lot of things. You've got the Japanese hiking rates, the Fed cutting rates. You could say, all right, well, the reverse carry trade is done. That's going to probably put some pressure on treasuries. Then you have things that are happening within the crypto market where Bitcoin is now, where are we? Under 87, under 90 we held for a while and actually clipped down to like 85 throughout this week. A lot of pressure on MicroStrategy right now with their, kind of jumble of packages of products that they're trying to do for dividends, etc. How does this unwind if MicroStrategy gets in trouble?
Well, it's definitely not going to be broader for the investor from a long-term perspective. And it's certainly not going to be good for the average investor who's just starting to tune into, I can buy a blockchain ETF. What do you mean? We don't really, I don't think that the blockchain in and of itself, of its own merit, is going to see a diminution, because there's just too many things that are being developed and brought to the market that are new technologies that have room to run. So I think that the bigger risk is that we get some kind of global macroeconomic transaction event. You say the reverse carry trade potentially, something like that could potentially, push people away or make people afraid. We really do want to see the use case of how all of these technologies perform while we have a recession, because we have a use case and say, look, it really isn't going to stay with equities. It's going to break away, and there's going to be a clear bifurcation of how they're performing and reacting to a recession or any kind of economic downturn. That would be very, very, very helpful. Any kind of individual, hey, this went really poorly, you could say, Bitcoin going down sub 90, could be like a little bit of an issue for people, but I really think that's ridiculous, to be honest. I mean, Paul, we've had these massive returns since April, since the tariff announcement, and you get a 2% down day, and the CNN Fear and Greed Index goes to extreme fear. People need to understand. They go. I'm not comparing it to the .com, but it is another technology implementation that we went through, and the monetization was ugly. We had 3 years in a row, 2000, 2001, 2002, that the S&P 500 was negative. That had never happened before. 3 years in a row negative. It has not happened since. So the lesson there for your average layperson investor who doesn't really follow the new frontier of technologies is, hey, it's going to be prickly, but I have to buy the rose. It's going to come with some thorns, but I have to have the rose. I can't be on the sidelines. And anytime we get anything like a MicroStrategies or anything like these things that are happening, we have to remember that's just part of the thorns that come with monetization. It is choppy and it's prickly. And as long as the investors have the right mentality going in and expect it, then they shouldn't get afraid and move to extreme fear. Those are the people that are never going to have the grit to withstand the monetization process. They're not going to make it. Well,
speaking of fear and greed, we're here on CoinMarketCap. You've got a 2.98 trillion, so dipping under 3 trillion again. Fear, of course, drops down on to 22, which we saw a low of 10, probably one of the lowest I had seen. And even altcoins, I don't think anybody's starting to go in that direction. But if you look at Bitcoin's performance right now on the 30, down 7%. Ethereum holding a little bit stronger at only down 3.7% in the 30, but on the last few days, it's been taking a little harder hit. Yeah. Then, of course, you get into the bigger tokens. XRP down 30 in the 30-day, 11%. Solana down 5% in the 30, holding on during its big announcement over at Breakpoint. A lot of big news there. But outside that, the top 10 is kind of littered with a handful of projects. I anticipate Hyperliquid's probably going to fall way back. The question is what's going to come up soon? So a lot of activity in the crypto markets. We're going to continue to cover this and more. Rebecca Walser, it's been great having you on again. Thank you so much for coming in. We appreciate it.
So great to be with you. Thank you, Paul.
All right. Where can they find you, Rebecca? What's the best place?
My website for our practice is Walser Wealth, WALSER wealth.com.
Perfect. All right. You guys do that. And we'll tag her down in the description below. And of course, you guys know what to do. Make sure and like and subscribe, but also share this with someone, because there's a lot of people that are starting to bridge the two asset classes together. What I mean by that is stocks and bonds versus what's going on in the crypto space. This is now becoming pretty much a unified market. So share that out there with them, and we will catch you next time right here on the podcast. Take care.